Welcome to the Ripple Effect YouTube channel. This is Wednesday, July 14th. This is Equity Armor Investments, the fantastic trio here today. I am Joe Tigay. With me is Luke Ribari and Brian Stutland. The three of us make up Equity Armor Investments. We are a financial advisory firm, so do not take any of these as recommendations to trade. Instead, just use it as your own information about the market. And talking about the market today, we are seeing a continuation of that. Inflation isn't going to cause the Fed to take rates up any longer rally. We're reaching all-time highs. The NASDAQ's leading the way. Even though today we got even more inflation data. We had the PPI coming in this morning. We actually had another beat of the inflation that came in at 1%, expectations of 0.6. So we keep on beating the expectations, and the market doesn't seem to care. So with all that said, I'm going to turn it to Brian. We're talking about the markets can go higher and lower. Brian, what's volatile today?
Yeah, there is volatility. Really, the volatility that's been in the markets has really been going on all year. It's been the NASDAQ. When you look at big tech NASDAQ stocks, technology stocks, we saw them flat to lower earlier in the year. All of a sudden, there was this big rotation. The NASDAQ now is up like 16% or so this year to date. So it's been quite a move for some of these stocks here. And I think what's going on is a lot of it's been trading on movement in interest rates. The 10-year note, as we've seen interest rates drop and fall from 175 down to 125 earlier last week or the week before, we've seen the NASDAQ in growth pick back up. So certainly tons of buying power by these big cap, large cap name stocks. And so when they get interest rates long term out that they can borrow, they can go buy companies, they can buy back their stocks and whatnot, and that's what I think we're seeing the rally right now. So everybody hated them at the beginning of the year. They're back in favor right now, and I think until the 10-year gets above 150, 155, they'll probably growth is back in for right now.
With all that said, what's an advisor to do out there? We got a lot of movements in the market. There's some key themes that advisors might be able to pick up on. And for us as traders, something we notice is that clients come to us and they don't necessarily want to make the right trade at the right time. It's really psychological. When things are really volatile, they might not be interested in hedged equity strategies. When things are less volatile, they want to go into the meme stocks, the YOLO trades. They want to get rich. What do you guys think advisors can be doing in this environment?
Yeah, I mean, I think when you're looking at advisor right now, we're seeing the VIX basically has made its round trip cycle, right? The VIX was at 15, 16 before the pandemic. It spiked, into the 80s. It's come all the way slowly back down. This cycle has been a long time. Obviously, the pandemic dragging that out. But now with the VIX down at 15, 16, I think it's time to start looking for volatility strategies that can be a better diversification than taking stocks and bonds.
Yeah, well, I mean, I can't say enough right now. We're coming up on some months where we're going to have some of the summer months, and then we coming up towards the end of the year to the volatile months, right? That's the first thing. Secondly, this run has been long. It can go on forever, hypothetically. But then again, you should be owning some volatility. You should be looking to see how things shake out. So if we get a little back to reality, come back a little bit and look at the move in interest rates, how low they are, and what a 50 basis point move can do to your portfolio. It's really time to set up with volatility so low, to set up a little more defensively, still be in the market, but be in the market in a hedged position. This is not the time, I think, to be butt long the market, as they say.
Yeah, absolutely. And I guess finalizing this point, this is the can go to zero mark segment of the show, reality being the thing that can go to zero. And sometimes it doesn't make sense, and sometimes as a trader, you just have to do whatever you can. Of course, it does not make sense that we're going to keep on pumping money into this economy, even though it is really high. It does not make sense, a lot of the decisions that everyone's making, but you know what? The largest point of a bubble is right before it pops, and we don't know if it's going to pop next year or tomorrow or 5 years from now. And so there is no other trade. There's interest rates are just
no choice. Yeah, the one thing that I always people think sometimes when we're talking we're shorting the market or we're negative on the market. No, you have to stay invested. You have to stay invested, but the best way to stay invested is to do decent asset allocation and have a part of your portfolio hedged in the way you're invested, and in a different style than normal ETFs and mutual funds, something a little bit different.
Well, I think that is a wrap. You're probably going to be hearing more and more themes of that until the bubble actually does burst. We'll be keeping you up to date in terms of the yield and which is in favor, value, and tech as we go along the way. We are Equity Armor Investments. This is the Ripple Effect. Remember, this is not an investment advice. And of course, if you're seeing us on YouTube, we'd really appreciate it if you followed us, subscribed, all that stuff that the people say. I think they say smash that subscribe button. I'm not going to do that at all. Anyways, thank you very much, and we will see you next week.